Hello, everyone, and welcome to another one of our Macro Mondays. It's episode 10, and we have lots to cover today. So, first of all, have we got a new carry trade on our hands, or the starting of? Is the environment in China going to lead to a situation where potentially you would have a carry trade going on with China and the rest of the world, or the West? Now, there are lots of different dynamics to this, and it's an early stage thesis or speculative kind of idea going around in very few places, and it has some merit. And the reason we're going to talk about it today is because the environment that's going on within China is setting up to basically allow for this to potentially happen in the future. Over the last week, China came out with the mother of all stimuluses. They have been stimulating their economy, and the rates have subsequently been going down. And for once, the market has believed them. So, is the market cottoning on to the fact that the amount of stimulus that has now taken place is enough to ultimately get China kicking again? Now, there's been a lot of disappointment when it comes to the Chinese economy over the last couple of years, and in terms of equity prices, many of them are still extremely beaten down and on a fundamental basis, potentially undervalued for a reason. This isn't the first time there have been actions taken to try and induce economic activity and I guess, more positive sentiment around China. But this is the first time that it seems like the market's really believing it and moving appropriately, I guess. You can see here over the last year, the Chinese KWEB, which is the yellow line, has been all over the place, and the S&P has been far less volatile and just been trucking up over the last year since October. Remember, October was when the US set the expectation that there would be 7 cuts in 2024, and you can see where volatility had happened throughout the year. Specifically, July through to September, there was 2 quite volatile moments, and yes, back in April, April, there was some volatility too. That was connected to the fact that rates just weren't coming down as quickly as the market had expected. And then you had the kind of topping out of the NASDAQ 100 and some volatility connected to the yen carry trade, which has now taken us to where the US Fed lowered rates, and now the Chinese have lowered rates, and they have also set out plans for stimulus. So you can see the KWEB has just gone absolutely nuts. What's in the economic stimulus package? Lower bank reserve requirements, which is quite interesting. That is basically reducing the requirements of capital in the banks, which in a sense creates a little bit of a concern around bank runs and other kind of liquidity related dynamics. The less reserves that banks have, the higher probability of issues that are systemic to these banks where they may basically become insolvent. And they've lowered the mortgage rates by 0.5 point. Remember, the Chinese housing bubble that was popped over the last couple of years was extremely frothy, built on lots of debt. Many households had most of their wealth in houses, and it was unsustainable and has recently been deflated, completely deflated. And remember, there was only a couple of weeks ago where we were talking about the concerns around outright deflation in China. So equity markets have reacted really well to this, and in a sense, you kind of would say it seems rational. Markets have now decided to start to believe a potential turnaround story for China, I'm guessing. Subsequent to all of these actions, the Chinese stocks post the best week since 2008 after all of this stimulus. The question will be, is there follow through on this? And are there real signs of a turnaround? It's on the backdrop of just a very negative period of time for Chinese investments in general, and very much a struggling Chinese economy for quite some time. So let's see if there's follow through. We'll be following this continuously with a lot of intrigue. Now, as the Chinese market is now being stimulated, iron ore is up 16% in 3 days. So it's again a reaction on, there's stimulus in China, there's going to be economic activity. The market is basically saying, hey, we believe it, or at least we believe that there could be a turnaround. So these price moves are huge, and they demonstrate that market participants are starting to get more bullish on a Chinese turnaround story. The backdrop around unemployment's at about 5.3% in China, and you've also got to bear in mind that they used to have youth unemployment in China, and there's been a lot of problems with younger people being unemployed in China as well. And then you have the US unemployment ticking up, but it's much lower than the Chinese unemployment levels. So something to watch out for. Essentially, the US employment picture looks much better than the Chinese employment picture, and we'll see if that is able to come down. Now, remember, a lot of the Chinese economy is around manufacturing and exports, and if the rest of the world continues to slow down, then it doesn't actually look great for China in that regard. Now, when we're looking at rates, the Chinese rates have dropped all the way down to 3.5, and the US rate is still at 5%. So we have a differentiation here between rates. We had a crossover point between 2022 and 2023. And this is really where you could see yourself setting up for a potential carry trade. I don't know if it has the same dynamics as the Japanese yen carry trade because of how people would potentially feel about participating so heavily in that trade. I'm not sure. We've had a lot of outflows of international investors. So investors are not really too bullish on China, and they've not been wanting to take risk related to China. So unsure whether this carry trade is going to pan out. However, it looks like it's setting up where the US rates will be higher than the Chinese rates, and that spread may mean that investors come to the party and try and find an arbitrage there. If this Chinese stimulus works and there's a dramatic turnaround in the Chinese economy, and subsequently the global economy would have to come along for the party as well and play along, you couldn't see domestic Chinese economy kind of picking up while there was a slowdown globally, because that would still affect Chinese exports. But the kind of speculation here is that commodities and asset prices could potentially boom as this kind of stimulus package starts the demand for economic activity. And you've seen some speculation in that regard around commodities, asset prices, and specifically some Australian shares that are connected to commodity prices. So there's a lot of enthusiasm and a lot of optimism around the idea that this Chinese stimulus package will basically is kind of the start of many governments, I guess, stimulating their economies to try and encourage economic growth. The problem being, and we'll get to it in a minute, is the debt levels around the world. Another person pounding the table on this Chinese trade would be David Tepper, one of the greatest investors of all time. He already has large Chinese investments, and he is now saying that he would be doubling down on a dip. And he is, from the filings that I've observed, quite overweight China. He's reduced a lot of his holdings in Western tech companies, specifically dropping about 85%, I believe, of his Nvidia position in exchange for picking up Chinese equities. He's one of those investors that takes very large concentrated bets when he believes that there's a clear opportunity. And in this case, he has found that there is a clear opportunity. The US and the West in general can't afford high interest rates for much longer, and they need to cut dramatically. The problem would be is if they drop rates too quickly, then there is a kind of continuation or a reversion where inflation starts to tick up and trend in the wrong direction. Right now, it doesn't seem like even if you cut rates, demand is going to magically pick up and get extremely active. Now, there may be some speculation in assets around basically rates going down, and that means that risk assets go up. However, I think from a fundamental perspective, we still have to see, and we will still more likely see a more slow rebound when it comes to economic activity in regards to rates coming down and that activity returning. It doesn't seem, at least historically, that would be the case. So perhaps it won't be different this time. Once inflation gets out of the bag, it does tend to kind of stick around and come in waves, and you saw that in the 70s. So it's not that necessarily inflation is guaranteed to be defeated. It's just that given where the kind of trend of economic activity is going, you would say that, well, more than likely inflation is kind of somewhat quote unquote defeated, even though inflation never really fully goes away, and it is transitory in its nature that inflation goes up and down from time to time depending on supply and demand. I just get a sense that given the data we have, that perhaps demand won't necessarily be there. If inflation was to persist, then it would mean that kind of rate may not be able to go down much further than kind of 4.5% or 4 to 4.5% on the Fed fund rate. The market's definitely pricing in a 3 to 3.5 handle. There are more and more people, especially even over, and I don't know if it's due to the election, even over the last couple of months, talking about the deficit, but also just that the amount of debt the Fed has on its books. So when more and more market participants talk about a problem and pay attention, it becomes at times self-reinforcing. A lot of people have been dismissing this kind of sovereign debt issue that the US has, but now we see more and more and more people talking about it. So that is a little bit concerning and could create some issues in the bond market. Given this issue around their debt, you are looking at potential issues with the currency. Right now, this could pose a problem for the currency, the US dollar. We have had many people talking about BRICS and kind of different regimes that could challenge the US dollar. Right now, the US dollar is still the only game in town. It is very well positioned to continue unless essentially people trust other currencies more than the US dollar. These currencies are fiat currencies, therefore they're essentially a confidence piece, and the US does still have the strongest army and the strongest military weapons, and many Western countries still trust the US dollar. So in terms of trust situation, as trust erodes, and perhaps Western participants in particular, because that would be the real driving force, decided that the debt problem was an issue and would mean that less and less people wanted to hold US dollars, then that could become a real problem for the currency. And with a differentiation in the two interest rates, you could see potentially some issues there and a potential new carry trade. Things like natural disasters are terrible to see. I've seen a lot of clips of this hurricane in the US really kind of taking it to Florida right now. What we'll see is lots of damages, lots of insurance claims. Unfortunately, people will lose their lives and be displaced, and it's terrible to see. But with these natural disasters around the world, they seem to be increasing, or at least with all of the high frequency information we're all getting, we're definitely seeing these in real time. So we hope that everything gets cleared up there, but it definitely will have an impact in local markets, and also potentially could have some consequences for some insurance companies in the US that are insuring around the area, and Florida in particular. Now, the unemployment picture in the US is relatively complex given how many people are coming into the country, and Relatively complex given that the initial jobless claims, which is where you claim for unemployment, the numbers haven't been too bad. You're actually seeing relatively stable initial jobless numbers across the board over the last year. So higher than this time last year for sure, and on average higher. You can see over this last period, if you take this most recent 6 months versus the last 6 months, you'd say that on average we've definitely got more people having that initial jobless claim. However, it's definitely been one of the reasons why people are calling for a soft landing. They're saying, well, people aren't coming in and saying that they're jobless. Now, that may have something to do with the fact that a lot of people that have been losing their jobs are in high-tech service companies, pretty well-off companies that give good severance packages, and they're typically in a situation where they don't have to run immediately and claim for unemployment. So let's see how this plays out. It definitely is playing into the thesis of the soft landing. If these don't increase, then I guess you could say that you have a strong position to call for that soft landing. Now, we do have the SAHM rule being triggered now, which is a 100% success rate when it comes to recessions in the US. Commentators in the market have mentioned that, well, because so many people are coming into the country, you've got immigration at such a high, then that would explain why unemployment is going up, because basically so many people are coming into the country that's unfairly taking unemployment up. It's an interesting theory, could be wishful thinking, could be correct, who knows? But one thing that is for sure is that unemployment is rising, and it's clear that it's rising. It hasn't gone vertical yet, so there hasn't been a tipping point. However, the SAHM rule is triggered, and we know that that has a 100% success rate, with the caveat that the inventor of the SAHM rule recently came out and talked about how it could be a little bit of a false signal here. So it's interesting when the person who has created the rule is saying, hey, maybe this time is different. And, when you've got a 100% success rate, you only need one time to be wrong in order to ruin that 100% success rate. So let's see. Essentially, without initial jobless claims going up, a lot of people are going to remain in the camp of soft landing. My observation here is that from a hiring perspective, it seems like hiring is mostly frozen across Western countries, specifically the US, but also Australia, New Zealand, Canada. The kind of hiring has really slowed down to a point where it's at a halt. So the next step is potentially layoffs. And I think that from a psychological perspective, we all want to save jobs naturally, but with the consequences of 2020 and the labor market getting so heated, many people that run businesses are so concerned around letting good people go and not being able to get them back at the right price that I think it's creating a bit of a barrier and definitely impacting people making decisions and trying to avoid redundancies at all costs. So we leave on the question of, will interest rate differentiation turn into a new carry trade? And I think that what we have to ask ourselves is, will market participants trust China enough to enable this new carry trade? We'll keep following it. It's an interesting one. I think that it's one of those dynamics that will likely take many years to come to fruition. However, it's definitely intellectually stimulating, and I enjoy thinking about the idea of something that kind of rhymes with the history of what's happened in Japan so nicely and so well that it is interesting. We thank you for listening to another one of our episodes. Remember, this is just for entertainment and informational purposes only, and nothing I have mentioned in this episode constitutes a buy, sell, or hold of any security or investment. We look forward to seeing you again next week. See you again then. Bye.